All right, let's jump right into this explainer. Today, we're putting Alexandria Real Estate Equities, or ARE, through the ultimate analytical gauntlet. We're stepping into the shoes of expert investment analysts to uncover the true intrinsic value of this totally fascinating company. If you've been following the real estate sector lately, you know it's been an absolute wild ride. So we're going to break down the hard numbers and see what's really hiding beneath the surface.
Here's the roadmap for our gauntlet today. We're going to start with a quick company snapshot, then view the stock through the strict lenses of three absolute legends: Warren Buffett, Peter Lynch, and Benjamin Graham. After that, we'll run some modern DCF and alternative models, and finally, synthesize it all into a final verdict.
Okay, part one. Let's get a quick snapshot of the exact company we're dealing with today.
Alexandria Real Estate Equities, trading under the ticker ARE. Right now, it's sitting at about $50.16 a share, which gives it a market cap of roughly $8.6 billion. They operate squarely in the commercial real estate sector, but trust me, they are definitely not your run-of-the-mill office landlord.
They're actually an S&P 500 urban office REIT, and they zero in specifically on life science and ag tech campuses. But here's where things get really wild. Look at this massive fundamental divergence. Over the last 12 months, ARE posted a crippling $1 billion GAAP net income loss, literally a $1 billion accounting loss. Yet at the exact same time, they raked in a massive $1.4 billion in actual free cash flow. That unbelievable cash generation is what's supporting their hefty 9.4% dividend yield. So you gotta wonder, how on earth does a company lose $1 billion on paper but generate over $1 billion in hard cash? Well, let's figure it out.
Moving on to part two, let's look at this exact setup through the Warren Buffett lens.
You know the drill with Buffett. He's always hunting for predictable businesses with wide economic moats. He wants consistent earnings, high returns on equity, and absolutely manageable debt. Plus, he demands honest management and a stock price that offers a huge margin of safety based on its intrinsic value.
And this perfectly highlights the ultimate push and pull with Alexandria. On one hand, they are the absolute pioneer in life science campuses. That gives them a massive, undeniable economic moat, which drives that incredible 49% free cash flow margin. But Buffett would immediately slam the brakes when he sees the other side of the ledger. They are carrying a crushing $12.8 billion debt load, leaving them with a debt-to-equity ratio of 1.5. When you combine that massive leverage with their negative accounting net income, their return on equity gets completely wrecked. And we all know Buffett watches ROE like a hawk.
So for Buffett, it all comes down to valuation. If we try to isolate their owner earnings, basically using that $1.4 billion in free cash flow as a proxy, and then apply a strict 20 to 30% margin of safety discount to account for that heavy debt and the broader sector headwinds, Buffett's theoretical buy price would trigger somewhere around $41 a share. So at $50 today, it's just a bit too rich for his conservative blood.
All right, part three. Let's shift gears and apply the Peter Lynch lens to see if we can find a hidden gem.
Lynch famously sorted companies into 6 specific categories: slow growers, stalwarts, fast growers, cyclicals, turnarounds, and asset plays. So the big question for us is, where exactly does a beaten-down, high-cash-flowing REIT fit in his playbook?
Well, look at the recent history. The stock has taken a brutal 50% nosedive over the last 3 years. But pair that drop with an incredible 49% cash flow to revenue margin, and this stock slides perfectly into the turnaround or asset play category. Also, just a quick note, since our source data doesn't highlight specific insider buying activity, we're going to assume neutral institutional and insider movement here to round out the Lynch model. So what's the ultimate verdict from Lynch? He'd likely call this stock a solid hold. Sure, the cash generation is incredibly tempting at this price point, but a true turnaround play desperately needs a clear catalyst. That massive debt load basically delays any real balance sheet restructuring that could kickstart the turnaround. Lynch would probably just sit on the sidelines and wait for a clearer signal before jumping in. Okay, part 4. Time for the uncompromising, quantitative rigor of the Benjamin Graham lens. If we run RS through Graham's defensive investor checklist point by point, it's honestly a bit of a mixed bag. It easily passes the size test with its $8.6 billion market cap, and it definitely passes the dividend history test with that huge 9.4% yield. But then it hits a wall. It outright fails on financial condition because of the heavy leverage, and it completely fails the earnings stability test thanks to that billion-dollar negative net income. But here is where things get really fascinating. If you try to run Graham's famous intrinsic value formula, the square root of 22.5 times earnings per share times book value per share, it literally breaks.
Since Alexandria's EPS is massively negative at minus 6.27, you mathematically cannot take the square root. It just gives you an error. And honestly, this is a brilliant lesson in the limitations of rigid historical models. The formula fails here, which proves you just can't evaluate asset-heavy REITs purely on GAAP earnings, because massive non-cash depreciation completely skews the bottom line.
So, since GAAP earnings failed us, let's move to Part 5. Custom discounted cash flow and alternative models.
Let's build out a base case DCF. We're going to use Alexandria's monster $1.4 billion in trailing free cash flow as our baseline foundation. We'll forecast that out 5 years at a very modest 2% growth rate. For the discount rate, we'll assume an 8% weighted average cost of capital, which perfectly aligns with industry averages for financing operations, and cap it off with a perpetual terminal growth rate of 2%.
Now, we all know precision is kind of an illusion in financial modeling. If you look at this sensitivity table, you'll see that tweaking the cost of capital or the terminal growth assumptions by just 1 single percent creates a massive swing in the stock's fair value target. But here's the real kicker. Across almost all reasonable scenarios in this matrix, the DCF model spits out a fair value that is significantly higher than the current $50 share price.
Let's cross-reference that with a couple of alternative models. If we do a comparable company analysis using price to cash flow, ARE actually looks deeply undervalued. It's trading at just 6.1 times cash flow. Meanwhile, peers like Kilroy are at 8.2 times, and BXP is at 9.4 times. Normalizing that multiple suggests a fair value right around $72. On the flip side, though, a standard dividend discount model, leaning heavily on that 9.4% yield, prices the stock much closer to where it's at right now, right around $47.
All right, Part 6. It is time for the final synthesis and our ultimate verdict on the stock.
When you consolidate all these frameworks, there is a very stark divide. The modern quantitative cash flow models, like the DCF and the peer comps, are screaming massive upside, placing fair value anywhere from $65 to $85. But then you have the traditional conservative gurus urging extreme caution. Buffett needs it to drop to $41 for a margin of safety, Lynch is holding out for a turnaround catalyst, and Graham's formula straight up rejected it.
So here is the crucial takeaway. You have to balance the company's unbelievable strengths against some glaring risks. On one hand, you've got a phenomenal 16% free cash flow yield and an absolute fortress of a life science moat. But on the other hand, they're fighting the vulnerability of carrying nearly $13 billion in debt right in the middle of a broader commercial real estate slump. So our final verdict? This is a speculative buy for investors who highly value pure cash flow and massive dividends, but it's a firm sell for traditional earnings-focused investors who just can't stomach that kind of leverage.
With fundamentals this polarized, I want to leave you with one final thought to chew on for your own portfolio. When you look at Alexandria real estate equities, are you stepping in front of a dangerous falling knife, or are you seizing a once-in-a-decade value play on a pioneering real estate giant? The numbers are all right there on the table, but the final decision is entirely up to you. Thanks for hanging out with me for this explainer, and remember, keep questioning the data.